All right, all right. Good evening, traders. January 2nd, 2024. And what are we going to do? We're going to start over on our Trading Foundations course. However, for anyone who went with us the first time around, this is going to be abridged. Doesn't mean we're covering less information. It means we're covering the same information faster. As far as the content library goes, both will be available. So you'll have the ability to follow along the recordings of this new session, but also go back and review if you wanted to, if you said, hey, you know what? Trading Foundation, understanding the financial markets was 2 full sessions last time. I felt comfortable squeezing it into one. And that's what I'm going to do with a couple of others and make sure that we cover everything. What that's going to do is that's going to give us the same amount of time for options. So instead of 24 sessions on trading foundations and 8 on options, we're going to go about 16 on both. So I think that's a better mix. I'm excited for it. That's what we're going to do. Let's get started. Welcome to the Market Watch Group Trading Foundations version 2.0. Today, we're going to start at the beginning, understanding the financial markets. We're going to hit this. You're going to be able to ask, if you went through the first time, it probably is going to make more sense, or you're going to pick up on something different the second time. If you're going through it the first time, great. You're going to hopefully catch some things that are going to help answer some questions, maybe dot a few I's, cross a few T's, and make you feel a little bit more comfortable understanding some of the basics. Good evening, Stephen. Good to see you. Hi, Perry. Hello to Shelly, who is new, or at least if I haven't seen you for a while. So glad to see you. Glad to come out. My name is Scott. Obviously, I'll be your host. Let's get into it. Here's the disclaimers. As always, they don't change. Stephen, holding my feet to the fire, said, when are we going to get our analytics video for section 7? I'm making a note of it right now. I've got a few video recordings that I need to work on, and I will add that to my list. Analytics video. You're right. You are right. Okay. Trade log sheet. With the extra, no, that's like I said, the holidays have thrown me off. My 2 kids have been home from college, and I've been spending every extra minute I have planning activities. So they're about to head back to school probably this next weekend, and my free time will open up quite a bit. So I will get caught up on a few things. Okay, let's hit the agenda. We've got 2 parts. Number 1 here, we're going to talk about types of financial instruments. We're going to talk about market participants. We're going to talk about order types. That's a big one. And that's probably one for some of you who went through the first time, where you're going to be glad to go through it again, because I can remember a fresh-faced young Scott working on the trading desk at Fidelity. I had recently acquired my Series 7 and my 63, and I still didn't know that much. And I would always have to pause and be like, you know what, Mr. Johnson, let me look into this further. And I'd pull up my online resource and remind myself what was what so I could explain it. It's just wrapping your mind around these different types: market orders, limit orders, trail stops, mental trail stops. When do we talked about the most dangerous time for stops. We talked about it today. We talked about it and said, if you have a stop loss, let's wait, I'll get to it. And then we'll talk about the impact of liquidity on utilizing stops. And then we're going to hit part 2 also today. So I'm going to just start cranking through. Ask your questions as we go, but you will have a little bit of time to ask some questions at the end. And we'll see how it goes. We'll make adjustments as we need to. So let's start with this. Types of financial instruments. A lot of different things available out there, especially now with cryptos and crypto mining and crypto swaps and farming and staking and all kinds of crazy stuff like that. But let's go to the basics here. We're going to talk about, first and foremost, equity securities. Equity meaning ownership. What do we own? We own stocks, right? And I know there's still a good number of you that are trading stocks. I still trade stocks. I have a tendency to do a lot of my short-term trading with options. We're going to talk about those here in a little bit. But equities. Uh, we'll sometimes talk a little bit about debt securities. And in fact, we've been talking about them more. Debt securities meaning bonds, right? Which would also be sometimes known as fixed income. Why would we talk about those now? Because interest rates just went through a period of excessive acceleration. And now we are at what we would consider to be, well, the highest in about 25 years. Definitely the highest in the last 15 years, where we've been riding, basically 0% interest rates for a long time. So all of a sudden, bonds are a much more viable alternative, which actually creates a slightly different dynamic for the market. For a long time, when there would be market weakness, the market still would just sort of sustain, not because people were super bullish on the market, but because they felt there was nowhere else to go. Where am I going to go? Put my money in gold? Yeah. Put my money in bonds and make less than inflation? They just sort of let it ride. Now, though, we can go get 6-7% on some high quality bonds. Well, that creates a viable alternative. As such, if any of you have thought, I should maybe think about some fixed income, yeah, that's a great time to get it. Because if the interest rates go back down, UBS came out and said they thought it was going to drop 2.5%, although today's market was a little bit stalled by the fact that now people are thinking those expectations are a bit overblown. Yeah. That they don't think it's going to drop that fast. But if it does, then anything you buy at 6.5, 7, when things fall back to 4, 4.5, 5, are going to increase in value and pay you a reasonable rate of return for what you're doing. So even though this is a trading group, we definitely want to make sure we're aware of other elements of the market that either A, we may think about participating in, or B, help to create the dynamic and the environment that we're trading in. Hybrid securities, mutual funds. So mutual funds will buy stocks, they'll buy options. Not a lot of options, but sometimes they'll buy bonds. They'll trade in options and futures. So it's a hybrid. You're basically giving your money to a company. They put it into a certain pool. That pool then creates the value of what you have. Derivatives. Oh, derivatives, how we love you. I'm a huge options fan. I don't trade a lot of futures these days, but we definitely look at the futures. In fact, every morning in our pre-market, we look at what are the futures doing. Why? Because they're trading. The rest of the market's not, right? When we start at 9:15 a.m., when I come out at 8:30 a.m. and start to feed the dog, let him out, and get on my phone and look at what's going on, I go into, in my case, I like Yahoo Finance, and I look at the news and the futures. How are the futures trading? This morning I came in, I'm like, oh, that's not good. They're red. So we watch the futures. We might trade the futures. Definitely trading options. We're going to, like I said, we have an entire course. And then, of course, you have your money market instruments, T-bills, commercial paper. Money markets are paying okay right now. You have money sitting in cash, you're a lot better off than you were a couple of years ago. That's for sure. So it's important for us to kind of be aware of the different types of assets, how they are traded, how they may play a role in our own investing, in our own market prognostication. And essentially it helps us to then determine which are we going to use and what are we going to use them for. Is commercial paper another name for CDs? Actually, commercial paper is tradable. You don't deal in it much. CDs are really more from individual banks, but maybe they would consider that a bit of commercial paper. I'd have to I have to go refresh myself on everything that would fall under that classification. CDs are paying pretty good right now. I think I was on my bank today and I was like, wow, 5.5% or 6% for a 1-year CD. It's not bad. Okay, so now what else do we need to know as we are learning the markets, as we're trading? What are some of the things we talk about? Who's participating? Generically, our market participants fall into two categories: institutional and retail. What's the mix? Institutional is 90%, retail is 10%. So institutions are who move the markets. Retail traders try to capitalize on the movements that the institutions make. That's how we see it. That's why we always look at longer term charts than we trade, right? The 3-year weekly. Why? Because that's what an institution's going to look at. And I want to make sure I see it how they see it. And when we look at sector rotation, it's a broader, longer term analysis. But what's that representative of? It's representative of how and where the institutions are moving their money. If we can see it early, it sometimes takes them 3, 4, even 5 months to move money in certain waves before we end up seeing like a consolidation or a correction. Retail traders can be big retail traders, smaller retail traders, but it's basically everybody else. Institutional investors include mutual funds. So Fidelity, Janus, Vanguard, White Oak, all these, right? There's dozens, hundreds of different mutual fund companies. That's what you typically are investing in with institutions, with mutual funds when it comes to 401ks, 403bs, defined contribution retirement plans. It also includes hedge funds. So hedge funds is a little different. That tends to be like mutual funds, but for the super rich, essentially. If you're going to trade in a hedge fund, you have to be a qualified investor, which typically means you have $500,000 liquid and a net worth over $1 million. That's typically what they're looking for to say, I am a qualified, quote unquote, qualified individual. You can invest in hedge funds. Hedge funds are less regulated. They can do different things. They don't have to report as much because they figure people who are qualified are more savvy. And so the government's not going to watch them as much. They can speculate in futures and speculate with options, whereas most mutual funds don't have the ability to do that. Also included in this would be pension funds and even insurance. A lot of insurance products become institutional money, annuities, whole life policies, where you have an investment component. That's all invested in the markets, right? So those are the institutions. That's where all the big money, it's all the little guys putting money to their pools, and then they're the ones controlling it. Then you have retail traders, retail investors. That's you and me. There's some that are bigger than others for sure, but it's the little guy, right? And you add us all up and we equal 10%. If you watched post-pandemic, there were a couple of they called them meme stocks. Meme. I always used to wonder if I pronounced that word correctly even. But if you remember, it was GameStop. Was it AMC? It was a movie company too. Anyways, there was a high short interest. The institutions were betting it was going to go down, and all of a sudden, some retail investors. Tell me if AMC. Thank you, Stephen. Yeah. So if you didn't hear about this, go read about it. It was interesting. But they got onto these Reddit chats, these little groups, and they said, if we all buy it. I mean, it took a lot of organization, but they did it. What they did is they created a short squeeze. So as they bought, it was pretty thin. And as they bought it, the price went up. And as the price goes up, it starts to trigger stops for people who are in short trades. And when it triggers a stop, that means they're buying the stock back. So when a short position buys to cover, even though they're just getting out, they're additional buying pressure. So what happens? If you've ever heard the term short squeeze, this is what happened. So as people start buying to close, they're also driving the price up. And as they drive the price up, it's triggering more short orders and blah, blah, blah. There it goes. That's what happened. Yeah. They had a good run. They caught a couple of institutions slipping. Caught him asleep at the wheel. Yeah, I don't expect that to happen. They've tried again and they've failed. So it was a few stocks that I think Best Buy maybe was on that too, or no, maybe it was Bed Bath and Beyond. I can't remember. Anyway, that's what happens as far as who's participating and what is the impact they can have. Okay, let's move on to order types. As we're trading, we have to place orders. And as we place those orders, there's different types, there's different conditions, there's different parameters even. You might see something that says FOK, fill or kill. You might see AON, all or nothing. We don't typically do, if you're trading under 1,000 shares or under 20 contracts, that's not helpful to you. I can promise you that. There's no reason to bother with that. We're going to focus on these generic types of orders: market orders, limit orders, stop orders. And then we're going to talk about the difference between stops and mental stops. So a mental stop is a stop is a hard stop. I mentioned this morning in our group when the market was opening down. I said, if you have a stop that's going to trigger, cancel it. Cancel that. Do not let yourself stop out on the open ever. That's a rule for me. And you might think, I thought you're not supposed to cancel stops. No, you're not supposed to stop out at the worst possible time when the market makers are going to absolutely clobber you. Let's give it the opening range. And if after 20 minutes, you still need to get out, I did. I closed IBM. Closed it exactly where I said I was going to, well above the low. I followed my rule. That's it. Much better price 20 minutes later, 30 minutes later, much better price, not even close. A mental stop. So a stop is a hard stop. That's where I'm placing a physical order where I say, if this crosses this point, get me out. It's automatic. A mental stop is where I say, you know what? I don't want this thing to close below here. My mental stops typically, if it's a bullish trade, is going to be higher than the physical stop. The physical stop is intraday. If all else is going terribly, I need an eject button. The end of day stop, the mental stop, is saying, you know what? This doesn't look like it's working. And rather than wait for the stop to come, we close the trade. We get out. That's an end of day close. We have trail stops. That's an automatic order. And then we have manual stops that trail. That's where I can set the stop, and then the next day I adjust it, and the next day I adjust it. So it's not just like automatically moving. I'm deciding where to move it. I use both. All of these are types of orders that we'll use. Let's go talk about them in a little bit more detail. So our basic starting point is market limit and stops. Market orders execute immediately it's actually not the current price. It's actually the next available price, which typically, because things are so fast, is the current price. But that's not the technical definition. So when we talk about a market order guarantees execution. It will fill immediately. What you don't know is the price. If it's a fast moving market and it's not very liquid, you might think, oh, I'm getting out at 50. And all of a sudden it's at 49.5, 49.20, because it's just slipping down. And there's no, by the time you get out, it's already down a little bit. That's honestly, I can't remember that happening since I watched the market drop in the 2000s, right? 2000, 2001, 2002. We saw some of that and at the pandemic, but that was only for 6 weeks. 6 weeks. Craziest, most volatile bear market I've ever seen or read about. But that's what a market order is. It's immediate. Next available price. You put it in, it's gone. Are you going to get favorable pricing? Absolutely not. You're going to get the absolute worst. Whatever the limit is, if you're buying, you're going to buy it at the lowest price or the highest price. If you're selling, you're going to sell at the lowest price, right? You're not going to get. If we do limit orders, we have the ability to work our way and try to squeeze it down a little bit. So what is a limit order? A limit order is set at a specific price and only executes when the market reaches that price. The verbiage you want to think about is at or better. At or better. So if I say I want to buy it at 50, I'm not buying it at 50.01. it's at 50 or better. Why do we have to put the or better in? Because if it closes at $50.50 and I have a limit order at 50 and the next day it opens at 49. Well, the market maker can't say, you know what, you were willing to pay 50, so we're going to just give it to you for 50. No, it's the next available. It's the at or better. So if it's 49, you're going to get 49, right? Anything better. Same thing with selling. If I put a sell limit at 70, 69.99 is not good enough. If it hits 70, bam, it immediately triggers and then it executes and I'm out. So limit orders allow us to say, hey, something's, $9.80 by $10. I'm going to put a limit at $9.90 right in between the bid and the ask. I'm going to try to squeeze a little out of the market makers and negotiate my entry and my exit. How likely are the market makers to negotiate with me? Well, if there's a lot of them and they're competing, more likely. So if it trades 100,000 shares, if it trades 10 million shares, I'm going to get better pricing. It's going to be tighter. It's more efficient. There's more competition. That's one of the reasons why liquidity is so important for us. Now, a stop order is a combination. So it's two prongs. There's the stop, and then there's what triggers by the stop. So there's two types of stops. You have a stop market and a stop limit. And just think about the orders. If I have a stop market, which is also considered a stop loss, that means that if it hits my trigger point, it triggers a market order. And a market order is next available price. Bam, you're gone. If it's a stop limit, I have a trigger. And when it hits my trigger, what does it trigger? It triggers a limit order, which means at or better. That is risky for trade management. I don't want you to use stop limits for trade management. Buy stop limits to get in, maybe. But when you're selling for a stop, it is a stop loss or a stop market, which means when it hits our price, we are gonzo. That's it. Now, understanding the differences is crucial for us, right? To know, like, what kind of order should I use? I really don't like trading at market orders. I just don't. This doesn't make sense. I feel like I'm capitulating, right? I want to work the limit order a little bit. But if I have a stop that's going to trigger intraday, I'm going to get what I get. I'm going to take it. I'm going to move on. So that's important for us to recognize. When is it time? Okay, let's keep going. Let's talk about trail stops and stops that trail. Mental trail stops are not placed as ordered, but monitored, right? We monitor it. We mentally watch it. Can we use alerts? Of course you should. I don't want to have to just be like every 5 minutes. Look, I want to be like, okay, you know what? I'm going to set an alert. So if it crosses this area, which is still above, the line in the sand I've drawn, I just want to know that it's entered a danger zone. Then I can pay a little bit more attention. Great. That absolutely is what you should do, is add the thought process of alerts to anything that you're managing, quote unquote, mentally. Typically, you're going to see what it looks like at the end of the day and say, you know what, that's too much. And you pull the trigger yourself. These are not automatic orders. You are manually placing these. Now, a trail stop, is automatic, right? So mental trail stops, or mental stops at all. So a mental trail stop, the same thing as I'm just sort of every day saying, now it's a little higher. Now it's a little higher. Now it's a little higher. What do I use for that? Heiken-Ashi candles, right? When we get to technical analysis, we'll talk about these candles. Heiken-Ashi candles are phenomenal for trailing orders. A trail stop is not going to, a trail stop is automatic. It's 50 cents away, $1 away, 5% away. You can do dollar or percentage. And basically you're saying that I'm going to place an order 50 cents below. And if the stock goes up 50, my stop goes up 50. If it goes up another 50, my order goes up another 50. Eventually, when that stock hits its highest point and starts to come back down, my order is locked in 50 cents below the high. And it stays there until it gets triggered or until the stock moves higher again without having closed my trade. Stops that trail are manually adjusted on a regular basis. So I'm gonna be either thinking about getting out sooner, or I can actually place a conditional or a contingent stock that says, if the stock drops below this point, get me out. And then the next day I can raise that point, right? I can say, oh, if the stock drops below 50, get me out. The next day I say, now if it drops below 51, now if it drops below 52, and oops. Okay, sorry. I just unplugged my microphone for a second. I did not want it to switch to my webcam for microphone. Can you guys hear me okay? Someone just quickly weigh in, let me know. Um, that is so those are the trail stops and stops that trail. What's my preference? Stops that trail. I like to manually adjust. I manually adjust the orders. Will I sometimes at the very tail end of a trade put a trail stop on? Yes. But more often than not, I am a stops that trail kind of a person. What are the most dangerous times for stops today? Market's a little bit riskier. Market opening, right? As the market opens, it was gapping down. And I said, if you have any stops that are going to get triggered, shut them down, get rid of them, and wait to work your way out if you need to. Now, there's a chance it recovers in that 20 minutes. And then you're like, hey, perfect. Now I can put my stop below the opening range. And if it recovers all day, fantastic. I'm still in the trade. I avoided getting out at the worst possible time. But that's the number one message I tried to project today. Don't panic. Relax. Let the prices settle down. Let's evaluate it, and then we can move. It's very important for us to understand when our stops are vulnerable in order to protect our investments. What does that mean? It means I took the stop off. I cancel it so I don't get hit. I can remember one time I was doing a class in the morning, and I went in, and it was same kind of a deal, and I was talking about it, and then all of a sudden the market opened, and when the market opened, lo and behold, what did I hear? Bling! And if you trade on Thinkorswim, you know that sound. That's a trade. That's a fill. And I'm like, oh, crap. Nothing was supposed to fill this morning. And then I thought, oh no, did I miss a stop? Sure enough, that's what it was. Sure enough. I looked at it. I looked at the price I got. 5 minutes later, it was already better, even though the stock was a little lower. But it ended up recovering, and I stopped out. And that's why I'm like, yeah, don't do it. Overall periods of increased volatility can increase the danger of stops. So basically, anytime the market has more vol, are we worried about that now? We've surged from 12 to 14. Not even. We dropped all the way back down. I'm not worried about the volatility of the market right now. What am I worried about? Market opens. If the market opens in a gapping fashion and it's going to trigger a stop, don't do it. Pull it off. I promise. Even if the stock is a little lower 20 minutes later, the fact that the prices have settled down, you're going to get a better fill. Okay, moving on. Lastly, for this, the impact of liquidity on stops. The lower the liquidity level, the wider the spreads between bid and ask. And consequently, and conversely, the higher the liquidity, the tighter. So essentially, that's the same premise with stops. When we say liquidity, we mean how much is it trading? So if it's a lot of trading, that means there's multiple market makers. If there's multiple market makers, that means they're competing, and they're going to work against each other competitively, and that's going to push the price between the bid and the ask down as tight as it can be. That's more beneficial to us. So I'm a liquidity snob, especially with options. You guys know I don't even look at it if it's less than 2 million shares a day. Don't even look. Prefer over 5 million shares a day. If that's the case, I don't have to worry about my stops. So if you're going to mirror our watch list, you're going to be in a pretty good place because our watch list is chock full of liquidity. We don't put thinly traded stocks on our watch list. We just don't. If you have something that's thinly traded, the stops are going to be a little worse. If it's thinly traded and you're trading the options and the options are thin, it's going to get a lot worse. A lot worse. There's a lot of slippage, and that slippage is what you're paying the market makers. Well, a lot of people think commissions. They're like, oh, it's commission free. It is, but it's not spread free. And that's part of the cost of doing business. Okay. Part one is over. Let me know if you have any questions about part one. Now what? We're going to jump right into part two. I'm going to fire hose these. I just don't see there's any way to do it. Right? And if there's a choice between leaving you overwhelmed or leaving you underwhelmed, I'm always going over. So bear with me as we accelerate on these a little bit compared to last time. Part two agenda. Now what? Now we got to talk a little bit about mindset and strategies. Because we have to pick as we tackle these markets. Are we going to be more oriented in fundamental analysis or more oriented in technical analysis? Right? Are you going to study balance sheets and profit loss statements, income statements? Are you going to do comparative research of debt to equity and book value rates between stocks of the same industry group and sector? Or are you just going to read the charts? I'm going to read the charts. I might look at something fundamentally now and again. I got to be honest. I just don't care that much. I read the market fundamentally. I look at employment rates. I look at GDP. I look at wages. I look at sales. I look at manufacturing. I look at a lot of fundamental aspects of the economy. But for an individual stock, I got to tell you, it's a lot of work. I don't think it's that necessary. Because if the fundamentals look great, but the technicals are garbage, it's still garbage to me. I still have to have a sense that the buyers are in control. That's supply and demand. That's what I'm thinking about. So I'm definitely more in the technical school. Time frames. What time frame are you going to be an investor and buy stock and maybe sell covered call against it? Are you going to be a position trader where you might be in for 2 or 3 swings, maybe a couple of months at a time? Are you going to be a swing trader 5 to 7 days? Are you going to be a day trader 20 minutes to an hour? Are you going to be a scalper? I'd even put a couple of them on there. There's a lot of different time frames. We have to pick. We can't move from one horse to another horse to another horse. Well, now I'm a swing trader. Now I'm a day trader. No, I'm a swing trader again. Will I sometimes switch? Yeah. If the market gets nasty and the VIX rises, is above 30, swing trading is going to be very difficult. It's going to kind of suck a little bit. Day trading is going to be fantastic. You're going to find big trends that you can trade throughout the day. So am I going to trade a lot less swings and a lot more day trading? Yes, absolutely. We need to understand diversification and risk management. We need to understand the role of trading psychology. Now, obviously, we're just going to be touching on this. This is just scratching the surface of some of these. And lastly, the role of the trading plan. That role, as you know, as we start on our trading plan, section 1, New Year's resolution. This is the year your trading plan is better than anything you've ever seen. We're going to talk about that. Let's get into part 2. Fundamental versus technical. So we use different approaches. Fundamentals based on financial data. Technicals based on charts, visual data. So fundamental analysis, as we said, you're studying the growth rates, sales growth, revenue growth, earnings growth. You're looking at valuation ratios, price to earnings, price to book, book to value, debt to equity. Right? Looking at P ratios, the PE ratio, the PEG ratio, et cetera, et cetera. That's a tough one because you have to measure stocks against their peers, and the peers are pretty limited, not even to sector, but more to industry groups. So you'll find yourself doing a lot of work with fundamental analysis. I prefer technicals. I want to use charts to help me understand supply and demand. So technical analysis is all about price action. Price is king. It's the most important thing. We use indicators, and we'll talk about that in a little bit as well, but we'll have 2 sections. We will still have some 2-parters, and technical analysis is one of them. So how you read charts, how you assign strength and weakness to buyers and sellers, to find who's in control, to find entry points where it's not just about, do I think it's going to go up from here, but do I think it's going to go up from here and I have a favorable reward to risk ratio? That's where technical analysis comes into play. I am absolutely 100% unequivocally a technical trader. And I would say beyond that, I'm a price action trader. I use price more than I do any indicator. How and when do we use each? Like I said, you may decide to use a fundamental filter or two just to let something get on your watch list where you say, you know what? I want my return on equity. That's a ratio that I like because it shows how efficient the management is of a company. I might say, you know what, I need positive return on equity. And that might just be a filter that I put on to make sure that everything I pick is profitable. Okay, fine. I don't do that, but you certainly could. So you could use it as a filtering mechanism. But as a trader, you're going to use charts. You're going to use technical analysis. Time frames are important. We have different time horizons from long-term investors who tend to buy and hold. There are, like I said, long-term traders, you might be years. Position traders, months. Swing traders, days to weeks. Day traders, hours. Scalpers, minutes. You need to choose the right chart. A lot of times I'll see people, they're on a 6-month chart, then all of a sudden they're on a 15-minute chart, and all of a sudden they're on a 3-minute chart. What are you doing on a 3-minute chart? I just want to see. See what? You don't just want to see, I promise you. You're like, Scott, I see you look at fives. I look at fives in the beginning to look at the opening range. I'm not trading that for the most part. Yeah. So any chart that you use, whatever the time frame is, you need to be very explicit with what is its role. Is this for perspective? Is this to create a support or resistance level? Are you going to use this to assess momentum? We need to make sure we know which approach aligns with our goals, our risk tolerance, and our life situation. If you work full time, you're going to have a hard time day trading, that's for sure. You need different rules, different plans, different mindsets, and even different record keeping to implement multiple timeframes simultaneously. I don't keep my day trading records with my swing trading records. They're very different. I'm going to put them on different I'm going to put them on different sheets. Yeah. Those are different products. You know, if you look at Walmart, Walmart's not, mixing everything. They're evaluating every product individually so they can understand which products are profitable. Now, does that mean they won't do unprofitable? No. If they know that someone comes in that buys something that's unprofitable, also spends $100, they're like, great, we'll keep doing it. We can certainly have reasons and rationale for why we might take a trade. For example, hedging. I said today, for people who are evaluating their hedging for 2023, if your hedging broke even or even lost a little, but you had a good year with your returns, great. What I don't want is that I hedged and my returns were okay. And it's like, well, what did the hedging do for you then? You probably should have just left it alone, because if you hedged and lost money, you're down a little from that. Your time frame should also be evaluated and determined based on underlying conditions of the market. Stronger, stabler markets are going to take a little longer. So I'm going to give trades a little longer. That's just the nature of the beast. So we want to make sure that as we evaluate and determine what our market posture is, we're very specific and explicit about what systems we're going to be implementing because of the conditions that we see. Diversification and risk management. Diversification across assets can reduce risk. What does that mean? It can. If you buy a bunch of different stocks and the market drops, pretty much all those stocks are going to fall. But if I buy some stock and then I buy some puts, well, now I'm diversified. Or if I buy some stock and then I buy some defensive components, that's going to be diversified. So I want to make sure that I'm in non-correlated assets in order to reduce my risk. I also want to diversify across different types of characteristics, not just asset type by sector. Right now, we have 5 sectors that we see strong. I'm looking to trade in any one of those 5. By strategy, what trade did I have on that did very well today? My time spreads did amazingly well, almost perfect. So my directional trades struggled as I'm waiting for new directional trading windows to open. What's doing well? My diversification of implementing a time spread, which is a non-directional trade. And that's where option strategy can be diversification. Based on the option Greeks, which Gary Pacanini covered so well the other day. I'm looking for another opportunity to bring Gary in and meet with you guys and start to bring him into the fold a little bit more. So keep an eye out for that. Okay, risk management. You guys, we have an entire section 4 on this. Every day when I sit down at my desk, my first thought is, how am I going to better manage my risk today? Manage your risk better. That's always what we're thinking. If you missed it, Press had a great comment in Discord today. I tried to answer where he said, in hindsight, he had some hindsight bias where he said, I should have done this. And I said, look, when you're cutting profits or when you're looking to evaluate managing profits versus cutting losses and letting winners run, there's no way you're ever going to be happy and fully satisfied with your results. If you sell everything and the market keeps going, you're going to be like, I should have kept some. But if you keep some and the market drops, you're like, ugh, should have sold more. Nah, we just got to live with that. That's just the nature of the beast. I wish I could tell you there's a way where, we're going to see our account at a high point. We're going to sell there. Nope, we're going to have to draw down a little in order to know whether the move is done, whether we have another trade setting up. It's okay. It's okay. It's part of the process. Risk management. When we get to the specifics, we're going to cover position sizing. How do I determine number of shares or number of contracts based on trade risk? We're going to talk about how many trades should we have on at the same time, number of concurrent trades, and that's going to change. We're going to talk about how much heat or total account risk should we have at any given time. These aren't guesses. This is very formulaic stuff. This is part of what's coming up in front of us. We know that we're working on this in a few weeks for section 4 of the trading plan anyway. So yes. And lastly, how do we adjust our risk management based on changing market conditions? Markets get better, take more risk. Markets get tight, take less risk. Expand and contract. Right? Expand. When we're on offense, we expand. If you're a soccer player, soccer fan, soccer coach, this is how we play soccer too. On offense, we expand. On defense, we contract. We get defensive. We pack it in. Pretty simple concepts, to be honest. Okay, let's keep going. Trading psychology. You guys know how big this is for me. Emotions play a significant role in our trading decisions. We're going to be discussing common psychological challenges and strategies to maintain discipline. Things like hindsight bias, preferential bias, inattentional blindness. There's a lot of different things, social and cognitive biases that can influence how we trade. And you don't know it. It's a bias. That's the point. You're not choosing it. It's a bias. Top 10 mistakes. If you haven't gone here, let me pause for 1 second. If you haven't gone here recently, this is one of the things I've been telling people to do. If you go into the welcome doc, bing, and you scroll down a little bit, here is the top 10 trading mistakes. You click on this, it downloads. Wait a second, it's downloading the wrong thing. Hold on, that's the wrong download. Okay, Scott will fix that. Oh no, I did the wrong one. There's the right one. That's on me. And then we pull this up and we have the top 10 trading mistakes. And I don't just list them. I list them here and then I write about them a little bit. I want you to find the two you do the most. Which ones are you most prone to? This is going to help you to figure out where a lot of your trading mistakes are coming from. So review these, read the document again so you understand what's happening, why it's happening, etc. How do I overcome it? And then we'll go from there. Oh, the welcome doc. Don't forget your resources that you have available. Absolutely. Okay. Our methodology is rooted in bringing trading psychology issues to the surface, addressing them head on. Let's talk about it. We don't pretend. We don't say, oh, if you want to be a good trader, you got to get rid of the emotions. Okay. If you want to be a good parent, get rid of the emotions. Good luck with either of those, right? It's okay. It's important we understand the emotion. Fear is very helpful. I absolutely do not want someone to eliminate fear. Fear of losing money, that should be the most significant that you feel. And everyone's like, yeah, I feel that. Then why are they letting their losses run? That's not fear of losing money. That's fear of being wrong, right? That's fear of regret. Oh, if I sell it today and tomorrow it comes back, I'll be so sad. So I'm going to hold on to it. We've all done it. I'm not using that voice to tease anybody except myself. I've done it. We all know that feeling. That's not fear of losing money. Fear of losing money is like, oh crap, I'm losing 300. I don't want it to turn to 1,000. What do? Sell it. Take your loss. When you see a train coming and you're on the tracks, get off the tracks. Okay. What's next? The role of the trading plan. How should you feel then? If you shouldn't feel fear or greed or pride, what should I feel? I should feel in control. You'll hear me talk about the professor, the chimp, the computer. The professor is the deliberate, the purposeful, the logical, the rational, the educated. The chimp is the panicker, fight or flight, right? It's a panic, it's a frenzy. And the computer is the automatic. So what do we want to do? We want to ensure that the professor's at the computer. If I say, how do you feel? And you tell me, the next question I'm going to ask is that how you wanted to feel? If that's how you wanted to feel, the computer is being run by the professor. If I'm like, how do you feel? And you're like, I'm a little scared. Do you want to feel that way? Not at all. Then watch out. The chimp is banging on the keyboard. So you better figure that out real quickly. So that's important stuff. I want you to think about the locus of control. What does that mean? If I said that around my kids, they'd roll their eyes because I tried to say it a lot to them growing up. But what does that mean? What can I control? I can't control the market, so I'm not going to invest myself emotionally in that, right? What can I control? I can control my risk. I can control myself. I can control the commitment and my discipline that I can control. I want to make sure that I recognize what I can control and make sure that I am in control. We gain control and ultimately confidence through the development of our trading plan, not our results. So if someone's like, oh, I had a great couple of months. Awesome. Did they come because your plan is strong or because the market was good? If they came because the market was good, get to your plan and get working on it because you're going to need it. If they came because you have a plan in place and the market's good, well, then fabulous, because I know that when the market turns not good, you'll be ready. You'll know what to do. You're not going to panic. You're not going to keep trying to do what you've been doing because you recognize that the market has shifted. Trading psychology should be a shampoo, rinse, repeat type thought process. Just over and over again. It's, we take a trade, we manage it, we get out, we learn from it, we do it again. Take a trade, manage it, close it, learn from it, do it again. Continuous improvement, Kaizen. That's our thought process. Kaizen. And it's more than a philosophy. Okay. And there it is. What are your questions? That's a lot. That is a lot. We cranked through it. I took a little bit of extra time. There were not a lot of questions. What does that mean to me? That means that you were mesmerized by the quality of the presentation, possibly distracted a few times by thinking to yourself, He's got a nice voice. I bet he's handsome. I don't know if anyone thought that for sure, but in my mind, that's what I'm thinking when no one's asking questions. So if that's not what you're thinking, ask your questions now. Doesn't have to be about today's material, but start with that. Otherwise, we'll spend a minute or two here, and then we'll go see what's coming up next. Up next is brokerage platforms and accounts. So we're going to talk about, what are you looking for in a broker? What do you expect your broker to do for you? How do you take advantage of your broker? What do you look for in a trading platform? How do you pick the best platform? How do you learn that platform? It's so quiet today. Thank you. Steven said, not a question, but what are my trading rules? I try to set where I will sell about 80%, be happy no matter what, I can get back another time. I love it. My percentage changes, right? When the market was choppier, I was half. In a better market, I'm going to sell just a piece, a quarter, maybe a third, where I'm like, all right, let's lock some gain in. That eases the risk because I have less to risk and I already secured some profits. I can manage what's left easier. I can stay in longer, easier when I've already taken a piece off. And then when I get to a point where I'm like, ooh, no, it doesn't look so good, maybe I'll take the next half off or the next third off and just leave a little piece. And if I leave a little piece and then things fall apart, I'm like, okay, all right, no harm, no foul. I love that. Scaling. That's scaling out. Someone asked a question the other day about scaling in. I don't, as an investor, you'll scale in, or a position trader, maybe. As a swing trader, we don't really scale in. We tend to get all in at once and then take pieces off as we go, where if you're trying to catch a trend, you put a little in, and then if you catch the trend, you put a little more, and then a little more, and then eventually you have a full position and you ride that trend for as long as you can. Awesome. I thank you for that. Steven said, what I'm learning from you in the graphs, it makes it easier to decide where to sell. Yeah, I mean, look, it just, we start to find reference points where we're like, yeah, let's take a piece here. And it's a constant. I think it's a constant. I appreciate the question. Appreciate the comment. Anybody else have one for today? Did very well with the INTC. You did. I got out. You and Perry, I think, stayed in. You guys cranked out some additional gains. Love it. Love it. Yeah, we got a lot of opportunities this week. I think you saw today the sellers tried. They couldn't do much. We really finished with more of a doji than a down day for the most part. I think setups are coming our way. So let's be ready. All right. Well, fabulous. It's amazing to see you all. 2024 is going to be a fantastic year. I feel it. It's going to be a good year. Great year for trading. We will have our alerts. Our alert service is going to come up soon. So, like I said, we're going to try to have a great starting point, but we're going to be ready to adapt as necessary. Adapt or die. That's our philosophy. Be water, my friends. So we will be on tomorrow morning. We will be on tomorrow morning. Maybe Steven said maybe during Q&A we can open mics. I told Gary, asked how he did, and I said, well, I'll tell you what, Gary, they love that you open the mic because I won't do it. Maybe if I had 2 or 3 people, it can be tough. Maybe now and again I'll open them one at a time. I'll think about that. Let me think about that. As our numbers grow, it's increasingly difficult to manage more than one open microphone. But I'll do what I can. Okay. Weekly check-in is tomorrow. We only had one day today, but we already are at our weekly check-in because it's Wednesday. And with the way the market moved today, it's probably a good time anyway. So I will see everybody tomorrow morning, 9:15 a.m. Eastern time. We'll take a look at how the futures, right? One of our derivatives, what the futures are doing. Look at the news, the calendar, look at our trades, see what's setting up, and go from there. I hope you all have an amazing rest of your night. It's good to see everybody. I will catch you soon. And as always, happy trading.